Since the S&P 500 was launched in 1957 as a stock market index in order to track the performance of the top 500 companies in the United States of America, it's been one of the greatest builders of wealth over the course of the past half a century. Because 65 years ago, the S&P 500 traded at just 43 points, and today it sits at 4,488 points. That's a total growth rate of 10,377% over that 65-year period. Now imagine if you were alive back in 1957 when the S&P 500 index was first launched, just how much money you'd probably have today. Would you have £500,000, £1 million, £2 million, perhaps even £5 or £10 million?
Nice.
And if you had those kinds of sums of money invested into an S&P 500 tracker, just how much could you actually draw down in passive income every single year in order to be able to live off? Well, today we're going to find out, because it's the reason why I will personally never sell my Vanguard VUSA S&P 500 ETF. It doesn't matter how many negative press articles there are over in mainstream media, it doesn't matter how many times someone calls out that a recession is on its way, and it doesn't matter how many times that Graham Stephan says that a stock market crash is just around the corner. I personally will never sell my S&P 500 ETF. So let me explain why. Well, the Vanguard VUSA S&P 500 ETF is designed in a way where it tracks the overall performance of the top 500 companies in America. But the S&P 500 itself is actually the combined market value of the top 500 companies, which currently sits at over $40 trillion. Now, in order to make that S&P 500 investable, over time, things have been created called exchange-traded funds, whereby companies like Vanguard and many others offer you a facility to be able to invest in their market tracker, which tracks the overall performance of the S&P 500. And as a result, you can gain complete exposure to the performance of the index in order to make and generate wealth over time. But how much money can you actually generate? Well, let's take a look. Remember how I said the S&P 500 grew at 10,377% over the past 65 years? Well, that gives the index a compounded annual growth rate of 7.42% per year on average. Now, of course, I have taken an average of those numbers, but the reality is some years the S&P 500 is up and on other years the S&P 500 is down. But in order to give us a little bit of an insight into the potential performance of the S&P 500, let's just use the average annualized returns instead, which, let's be honest, pays you a hell of a lot more than what your current account will, and potentially over the next 65 years into the future, hopefully those returns will beat the 7.42% average rate of return which we've seen in the past. So what exactly happens when we start to plug in the numbers? Well, first up, there are two variables which you need to consider because they're really important in dictating that future value. The first one being how much you can actually afford to invest. Because there are, broadly speaking, two different approaches to investing. The first one being lump sum investing, where you essentially throw all of your money in all at one time, set it and forget it, and just let it compound throughout the course of your investing lifetime. The alternative being to take a percentage, perhaps 10% of your monthly income, and invest that money every single month into your investment account. It's the approach which I use, and it's something called cost averaging into the market, or if you're over in America, they call it dollar cost averaging. Now, of course, everybody watching this video is going to be in different situations, earning differing amounts of money. So because of that, we're going to use a few different variables just to give you guys a little bit of an insight as to how much you could potentially generate over the course of your investing lifetime, depending on how much money you're earning today and in the future as well. But before we do that, the second consideration is how long you have to invest. Because again, everyone's investing time horizon is going to be different depending on how old you are and how long you plan to invest for. If you're in your 20s like me, then you've probably got at least the next 2 to 3 decades before you're even probably going to want to consider drawing down on your investment portfolio. But if you're a little older, on the other hand, then you probably got a little bit less time before you ideally want to hang up your boots and start to live off your investment portfolio and any retirement funds which you have. Now, there is one general rule of thumb to follow here, which is the simple fact that the more you can invest and the longer investing time horizon you have, the richer you'll become over the course of the long term. So let me share with you guys the numbers. So guys, welcome to my portfolio tracker. This is a spreadsheet which I've been building out over the course of the past few weeks and using it in order to track the overall value that I have within my investment portfolio. along with doing some future planning too, which is where the compounder is going to come into place to help us answer some questions around the future values of our investment portfolios. I'll probably dive into the depths of this spreadsheet perhaps in another video, but for now, let's take a look at the compounding section instead. So simply, this is a compounding calculator which does some fancy formulas and spits out the overall total value of our future portfolio. So to begin with, what I'm going to do is we're going to start off with an investing principal of £1,000, and then we're going to achieve the annual interest rate, which I referenced at the start of the video, which is a compounded annual growth rate of 7.42%, or we'll round it up to 7.5% just to keep the numbers clean. We're then going to do that over a 40-year period, and then we're going to make the monthly addition with the first variable being £200. But we're also going to increase that every single year with inflation at 2.5%. Now that spits out the total portfolio value over on this graph, which you can see here at £773,715. But the question that you might have is, well, if that's my total portfolio value, how much will I actually be generating in terms of passive income via the means of a dividend yield? So what I'm going to do is I'm going to come up over here where we can see the passive income generated. I'm just going to type in the ticker symbol of the Vanguard S&P500 ETF. It's going to pre-populate some data, and then we're also going to put in the dividend yield, which I know is 1.16%. And as a result, with this total portfolio value, having invested £200 a month during 40 years, you will end up with an annual income, passive income of £8,975.10. However, let's say you've got a little bit more disposable income on your hands, and you can actually afford to invest £500 a month. Well, when we plug the numbers in, again, you can see the portfolio value absolutely skyrockets to just over £1.9 million. And then the same again, when we look at the annual income figure, that's going to give you £22,123.78 to live off. But then let's say you've got even more money at your disposal and you can actually afford to invest £1,000 a month. Well, at that point, you then have a total portfolio value of £3.79 million. And again, at that same 1.16% dividend yield, that gives you an annual rate of income of £44,038. And the final monthly addition that I'm going to plug in is if you can afford to invest £2,000 a month. Again, assuming all of the same other criteria, you will actually end up with an end of year principal in year 40 of £7,574,758 with a total annual income, passive income of £87,867.20. Now, of course, looking at the annual income figure on its own is just the completely passive approach to living off your investment portfolio during retirement. However, what you do also have to consider is that your investment portfolio will still be growing every single year. So you can actually draw down on the additional capital gains and actually look to live off that amount as well. So to give you guys those numbers and the potential additional money that you could draw down on your investment portfolio, well, if we scroll down, I've got a bit of a summary here on your portfolio and the monthly additions, as well as the income that will generate from the monthly additions which you've been able to afford to make. But down here we have the overall growth numbers, which you can see if you do £200 per month, again increasing with inflation, you will be able to draw down after 40 years another £53,530 on top of the nearly £9,000 in passive income too. If you made it up to £500 a month, it's going to jump to £131,938 on top of the additional £22,000 in passive income as well. So that's nearly 150k that you can draw down on your investment portfolio simply by investing and getting to a point where you can afford to invest £500 per month. And then the numbers simply spiral upwards. You can see the stretch plus goal at 262,000 plus your 44k in passive income, along with the end goal of a couple of grand a month, which sits you at a capital growth rate of £523,975 plus the passive income of £87,867. Now, of course, all of those numbers are fantastic. However, you will need to bear in mind that there may be some capital gains tax to pay on those amounts which you've managed to generate over that period, depending on where your investments are sat. If they're invested into a tax wrapper like a stocks and shares ISA, then you will not be liable for capital gains tax. However, if it's just in a general investment account, then unfortunately you will be liable to pay capital gains tax in 40 years from now. However, regardless of tax, inflation, any of those other variables, you can see quite clearly that if you just have the right principles in place and you're consistent with your investment portfolio, you will be able to grow and generate quite a lot of wealth over the course of the long term if you simply let the power of compounding do all of the work for you. And as a result, that is the very reason why I personally will never look to sell my Vanguard VUSA S&P500 ETF. Now, if you guys do want a copy of this spreadsheet, be sure to let me know down in the comment section below. It's a bit of a program now that I've started to build out that I may look to make public at some point in the future. So that said, guys, if you do want to take a look at what other ETFs are out there that could also be potentially fantastic investments over the course of the long term, then be sure to click on this video here where I talk about some of the top funds over on Vanguard. And with that being said, I'll see you over in the next video.